Whilst there's been a really strong trend towards self-managed super funds in Australia in the last decade or so, the first fact I want to present is that the majority of people still rely on the professional funds management industry to grow their wealth for them. And the second fact is that those fund managers have really been doing a terrible job while continuing to skim vast sums of money off the top. There's one thing you can count on, and that's they'll get paid first, and regardless of whether you grow your wealth or not. Just look at the performance of stock market indices in the last decade compared to commodity prices like gold, silver, oil, or copper. It's the price of commodities that really determine your cost of living, and those prices have been soaring in the last decade. Just think about what it costs you to buy petrol, building or renovating a house, cost of most consumer items due to rising manufacturing and transport costs, etc., etc. You know, and I know, that the cost of living is rising much faster than politicians are allowing us to be told, because they're massaging the CPI figures. Now just consider the following. Copper is up from 85 cents a pound to $4 a pound, which is a 370% rise during that period from 2001. Oil is up from $28 to $100 a barrel in that same period, or a 257% rise. Gold is up from $265 in 2001 to $1,750. That's a 560% rise. And silver similarly is up from $5 to $34 after peaking at $50 last year. So that's a 580% rise. Yet the All Ordinaries Index in Australia is only up by 32% from 3,200 to 4,300 points, and there's been zero growth in value in the last 7 years. And on top of that, the S&P index in the US has made no net gains since January 2001, despite a great deal of volatility. The fact of the matter is that if your money's in the stock market long term, in the normal way, through a fund manager, the purchasing power of your wealth is being rapidly destroyed. So what about the future? Will markets return to normal growth paths as the industry would have us believe? Or are we now in a new normal where extremely low growth is what we can expect? My answer emphatically is that the next decade is highly likely to be like the last, or even worse. There are numerous reasons for this, but the main one is that there's a global restructuring of society going on. The world has spent the last 40 years in a debt-fueled consumption binge, which is now finished. And we're now entering a multi-decade deleveraging cycle, which will render many sectors of the stock market redundant. That means that if your investments are broadly exposed to the stock market, they will drastically underperform and will certainly lose purchasing power compared to the real levels of inflation, and may even lose value in nominal terms as well. I can promise you there'll be some spectacular rises and declines in the market in the next decade, and there'll be numerous panics where investors will feel bewildered and generally take inappropriate actions, because that's just how human psychology works. So what's the answer? Well, to me, it's very simple. There are some sectors of the stock market and a few specific businesses within those sectors that will perform outrageously well, regardless of what's going on around them. Let's have a look at a couple of examples. A $1,000 investment in a now major engineering company called Monadelphous, stock code MND, in 2001, has now grown to $33,000 in capital value, which is just staggering. Plus, along the way, they would have paid you $7,965 in dividends. But the real kicker in these days of highly volatile stock markets is that you would now be receiving a $1,650 dividend payment in 2012 based on the shares you bought in 2001. That's a 165% return per annum on your original investment. So when you're receiving that type of return, who cares about the stock price? This is how Warren Buffett became a multi-billionaire. Invest in great companies and let compounding work for you, as long as they remain great companies. There are not many companies where you can find this kind of performance, but they are out there. As another example, a $1,000 investment in another emerging engineering business called Forge Engineering, when it was flashing buy signals in 2009 after the GFC, is already worth $12,000. You would have got 60% of your investment back in dividends since 2009, and the company will pay you $280 in 2012, or a 28% return on investment. Do you care if the stock market falls? So as long as history stays intact, your wealth is growing rapidly. What a great position to be in. How the stock market performs doesn't impact your wealth or your income stream. These companies and a few others literally sailed through the GFC with no impact on their financial performance at all. It was just their share prices took a big dip. But when you think about it, this was just the market hanging out a sale sign. The vast majority of investors can't bring themselves to buy because the media and the biases, their own biases, convince them that there is still worse to come. But this is the best time for buying. Now, what can go wrong with this approach if you were managing your own money? First thing is, you need the ability to select great businesses. And most people don't have the knowledge, the time, or the inclination to do this kind of in-depth analysis. Secondly, you need to have the discipline to regularly track the financial performance of these companies and the industry sector that they're in. And I'm not talking about just checking the share price. I mean a regular evaluation of the 6-monthly financial data. And thirdly, you need to be able to shut out the opinions of the world, which are always wrong every single time at the extremes. And those opinions will have you selling at the lows and buying at the highs, which is obviously a great way to destroy wealth. The majority just aren't in a position to do any of these tasks reliably. However, the alternative is to draw on the support and the expertise of someone who's had 25 years of very hard-won experience in the market and has committed the next 10 years to guiding a group of private investors through the minefield. The focus is on identifying and tracking businesses that are like MND and FGE. Now, I hasten to add, I'm not an advocate of buy and hold to create wealth, because those days are long gone. Most of our investments are actively managed to exploit the natural cycles in the market. However, there are some very specific investments, such as those covered in this essay, which do lend themselves to holding longer term, because the company is financially very solid and the dividends are highly likely to grow rapidly and reliably over the long term. These are opportunities that are just too good to pass up, but it's all about getting the balance right for the prevailing conditions. If you'd like to know more, then go to our website as shown below.